Welcome back to the Tuesday Target Audio Companion. It's August 18th, and this week's letter is called Korean Degens and Dancing Rothschilds. Constantine, I read that title and thought, okay, Yuri's in a mood.
He absolutely is. And here's the thing. The market looks like it took a sleeping pill. VIX at year lows, everyone at the beach. But Yuri's whole point this week is that somebody sold you that calm. It didn't just happen.
Right? And the somebody is wild. Korean retail traders, the same crowd that swore off stocks 2 weeks ago, is back, and they're selling billions in these exotic notes on Nvidia, Micron, Tesla. Autocallables, they're called.
20% coupons. Sounds amazing, right? But in plain English, they're collecting rent for insuring the market against big moves. The dealers on the other side hedge by dumping volatility, and the whole tape gets pinned. $300 billion of this paper has quietly coiled the market into a spring.
And springs snap. History says these setups grind lower, then gap violently higher, and everyone has to chase.
Meanwhile, the pros got humbled too. Jane Street, the trading machine that basically ignites momentum and skims the spread both ways, just posted a $15 billion loss in July. First down month in a decade.
Flattened by the very reflexes it built. The herd hunters became the herd. That line stuck with me.
And then the oldest money in Europe. The Rothschilds Monaco Bank openly calls AI a probable bubble, then tells clients, stay invested, own the shovel makers, watch credit for the exit signal.
2 centuries of banking wisdom in one sentence. Dance while the music plays, near the door. Okay, what else jumped out at you?
The AI debt story. AI-related borrowing has hit $269 billion this year. That's 12 times the average of the past decade. And all that paper competes with Washington for the same bond buyers.
So the creeping fear becomes, who controls long-term yields anymore? Nobody, apparently. And speaking of nobody in control, the oil section. The Strait of Hormuz stays closed, Iran turns openly offensive, and oil just sits in the mid-80s.
That one's clever. Washington fires contradictory headlines daily, whipsawing prices so violently that traders' risk models force them to stay small. Nobody can hold a position long enough to push crude higher. Volatility itself became the weapon.
While inventories drain by millions of barrels a day, break that range and another spring snaps. Then there's the seasonal warning.
Since 1990, the equal weight S&P has pulled back at least 7% in nearly every August to October stretch of midterm years. And we're walking into that window at record highs, with hedge funds buying every single day last week.
At the second fastest pace in a year, momentum begets momentum. And gold?
Gold wins both ways. Back above 4,400, central banks buying, and it rallies whether markets fear inflation or deflation. Forecasts near 4,900 suddenly look less heroic.
One more, the data center reality check. Of 500 gigawatts announced, analysts judge only a third credible. 5% actually underway.
Check who the tenant is. Hyperscaler-backed projects get built. Promoter slideware doesn't. Okay, the trade. This week's Tuesday target is TLT, long-term treasuries.
Everyone hates long bonds. 30-year yields at their highest since 2007. Trend followers max short. And that's exactly the setup for a stall. Sellers exhausted, but every rally capped by trillion-dollar supply.
So TLT chops sideways while both camps catch their breath. Yuri sells that indecision with a 31-day iron Condor and lets time decay pay daily. Screenshots and details are in the letter.
And the tactics for this tape? Stay invested. Stop chasing. Protection costs pocket change right as the calendar turns hostile.
When insurance is this underpriced, wealth preservation and opportunity finally cost the same. That's the whole letter in one line.
Full breakdown, charts, and the daily dose boards are on the macrodozer.com. See you next Tuesday.
Dance near the door, everyone.